RioCan has reported a rise in profit for the fourth quarter on lower revenue. The Real Estate Investment Trust says it's seeing rising demand from leading retailers amid a shortage of well-located retail space. So for more on the future plans, joining us now is Johnathan Gitlin, President and CEO of RioCan. It's good to have you join us. Thanks so much.
So nice to be here with you, Lindsay.
So you say you're optimistic about rising demand from leading retailers. Why is that?
Well, I think that the retail landscape in Canada is very strong. A lot of the retailers that we have in this country are growing, and so there's significant demand. I'd also say at the same time, there's limited supply of good open-air, necessity-based retail space, which is what RioCan has. And so we see continued use for our space, and we feel that the retailers that we cater to are definitely in growth mode because they sell consumer goods that are necessary in really any economic backdrop, whether we're in growth mode or whether we're in a recessionary mode. People need, the common things that are needed for day-to-day life.
Okay, so you're saying any consumer spending habits that we see, whether people start spending less, that doesn't really affect your company?
That's right. We've catered our portfolio to really function well for necessity-based retailers. So grocery stores, dollar stores, gyms, things that really thrive in any kind of backdrop.
Okay, when it comes to retail space, I'm wondering if there's particular regions or segments where you see demand growing and then vice versa, where you see demand a little weaker.
Our focus has been on the major markets, big cities like Toronto, Montreal, Ottawa, Calgary, Vancouver. And the reason for this is because there's a significantly higher demographic in those markets, and that's exactly where our tenants want to be. So if you look at our average 5-kilometer radius population, it's over 270,000 people with an average household income of over $155,000. And those are the people who are obviously spending, they have the capacity to spend more, and they're spending on the exact type of product that we're offering in our centers. And so I do feel that those major markets have that demographic advantage. But that being said, Lindsay, we're seeing demand across the entire country right now. There's, I would say, a structural shortage of good retail space. And, so we're actually hearing about our colleagues who own properties outside of those big six markets, and they're also in high demand. But I think that the longevity of demand is going to be more prominent in markets like the ones where RioCan owns.
So are you not seeing much weakness then? Like I know I take your point that you said you're seeing demand across the board. So there's no areas where you're seeing weakness instead.
Not from our perspective. RioCan's portfolio currently sits at, our retail portfolio currently sits at 98.5% occupancy. Our leasing spreads this last year were at 21%, which means that tenants are paying significantly more to renew space than they were before. And there's just not a lot of supply that's been built. So I think there's a structural shortage of new retail space. So we're seeing demand across the board, keeping in mind the space that we occupy, or the space that we operate in, is really that necessity-based goods. So I'm not talking about luxury goods. I'm really talking about common day-to-day goods. And yes, I think the demand for that type of product is very strong within the Canadian landscape.
Okay. I'm wondering now if you can give us an update on the Hudson's Bay locations, that situation. Like, how long do you expect to see that affect your bottom line? And what plans do you have at this point for any of the remaining locations?
So the Hudson's Bay story is one that I would that is largely in RioCan's rear view. We've dealt with all of the space, and at this point, there's no further economic impact on RioCan. We have taken a few spaces in our portfolio and released them at rents that are far higher than what the Bay was previously paying, and so really it's just upside from here on in. But from an economic perspective, all of the impact has been addressed, and we no longer have any further exposure going forward.
Okay. In the third quarter, you had reported weakness in rent growth and occupancy in some markets for rental buildings. What's your strategy for your apartment portfolio in the year ahead?
So we're in the process of selling a lot of our RioCan Living portfolio and really focusing on our core retail portfolio. But residential, look, I think it's a great asset class. I think that there's going to be pockets of time like we're in right now where there's a bit of a saturation in that space. But I do think long term, it's a very good asset class. And I think for assets like the ones that RioCan Living had built and owned, they're new, they're on transit, they're in major markets. And so even though there was a bit of slippage operationally, we think over time that corrects itself.
I know in the last quarter, retail occupancy went up, but commercial occupancy was flat. Correct me if I'm wrong. Do you expect to see that trend continuing? Do you expect to see it improve as we move forward?
It's pretty hard to improve from 98%, but which is functionally full. But really, the retail occupancy is at 98.5%. The overall occupancy is slightly lower because we do have some office in our portfolio, which is still operating at about 90% occupancy, which is fairly strong for that asset class. Do I see that improving? The answer is yes. I think office, particularly where we own, is in demand, and we are seeing a nice momentum in that space. So we do think that the overall occupancy rate, well, it'll stabilize or increase over time.
I think we touched on this off the top, but do you have a certain segment that RioCan is going to be really focusing on for 2026?
It's really our own retail. We love retail. We're we have a very significant platform that allows us to drive a lot of growth in that portfolio. And so we're really focusing, Lindsay, on things like buying back our own shares, which is really just investing in our own portfolio. And then also building out pads and strips and smaller parts of existing shopping centers, which create a lot of value on a whole bunch of different dimensions. So we're excited about that opportunity, and we see a lot of growth coming through that. And otherwise, it's really just leaning into the strength of our portfolio and leasing at higher rates and getting better tenants in our space.
Okay, we will leave it there. Johnathan Gitlin, President and CEO of RioCan, appreciate your time. Thanks for joining us.